Ladies and gentlemen, good day, and welcome to the Q1 FY26 earnings conference call of Ramkrishna Forgings, hosted by IIFL Securities Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Joseph George from IIFL Capital. Thank you, and over to you, sir.
Thank you, Muskan. Good evening, everyone. On behalf of IIFL Capital, I welcome you all to the 1Q FY26 results conference call of Ramkrishna Forgings. I also welcome the senior management. From the management team, we have Mr. Naresh Jalan, Managing Director, Mr. Chaitanya Jalan, Whole-Time Director, Mr. Lalit Khaitan, Whole-Time Director and CFO, Mr. Milesh Gandhi, Whole-Time Director, and Mr. Rajesh Mundra, VP Finance and Company Secretary. Now I will hand over the call to Mr. Khaitan to take the call forward. Over to you, sir.
Thank you, Joseph. Good evening, everyone, and thank you for joining us on the call to discuss the Q1 FY26 results. I trust all of you have a chance to look at the earnings that we have shared earlier. Financial year 25-26 has commenced on a challenging note. There has been a lot of noise on tariffs and the resulting volatility and uncertainty, coupled with macroeconomic challenges, has caused an environment where customers are hesitant to spend and OEMs are cautious in the projections. As a result, we also have witnessed sluggishness in demand from our customers. To begin with, what's top of the mind of everyone are the tariffs recently announced by the US administration, including those on automobile and auto component imports. While the specifics continues to evolve, we believe these measures will primarily impact demand in the short run. There could be a scenario where some opportunity open up, but there will be some disruptions in demand and supply. We have all seen the announcement from President Trump that tariff of 25% will commence from August 1, and are closely monitoring the development to ensure that we comply with all applicable regulations and any potential disruption for our customers is minimized. Secondly, the other development that has emerged, and this will impact all markets, is the potential disruptions due to supply chain complexities and heavy reliance on China for rare earth material. If China imposes restrictions, automakers could encounter certain challenges. On the top of these two developments from a global perspective, coming to the India market, we have seen the Q1 of the current financial year mixed trend with the headwinds and the muted industrial output. A bit slowdown in some of the industrial sectors, the IIP numbers, etc. For commercial vehicles, we saw volume decline in the overall market, though at the RKFL we have been able to improve on our domestic performance. And further, I would like to add commercial vehicle segment has been under pressure lately, but signs of recovery are also emerging. Coming to capacity addition, we commenced the financial year at the present capacity of 268,400 ton, and we are in the process of adding our 8,000 ton press line and 3,000 ton aluminum forging facility that will add capacity further by 43,000 metric ton during this year. Now let me share some financial highlights for the first quarter. We reported consolidated revenues of rupees 1,015 crore, that is higher by 6% on year-on-year basis. EBITDA excluding other income for the quarter is 149 crore, which is lower by 20 crore compared to EBITDA of 169 crore for Q1 FY25. EBITDA margin consolidated stood at 14.6% and lower by 300 basis point year-on-year. And profit after tax for the quarter is 12 crore compared to 55 crore in Q1 FY25. The above profit is impacted mainly during this quarter on decrease in realization and change in export domestic mix. And the impact together of this change in mix and the realization is about 40 crore, which we have highlighted in our presentation also. Further, there are impact on the inventory valuations also on the warehouses overseas due to correction in indexes. Apart from that, There is a forex loss accounting in our JV Ramkrishna Titagarh Railway due to the on import of machines, and it has now the machine has already reached the site. So we have to account for the forex loss, and for our share we have to account for a loss of 6.66 crore in this quarter. Apart from that, we have also incurred a 5 crore loss in Ramkrishna Forgings Limited on account of import of machines which are under installation. So altogether, there is an impact of about 52 crore on the profitability during the quarter. Now I hand over the proceeding to Mr. Milesh for having you an update in marketing. Over to Milesh.
Thank you, Lalit. I would like to brief the audience. The company received new orders worth 660 crores in quarter one, program life being 4 years. And for railways, we received an order of 23 crores for the 1 year period. Against the above, export orders are worth 502 crores and domestic orders are worth 158 crores. In the domestic orders of 158 crores, 99 crores come from the off-highway segment, 59 crores come from the commercial vehicle segment. In the exports, against the 502 crores, 307 crores comes from the passenger vehicle segment, that is the PV segment, and this also includes orders directly from American OEM. Apart from that, 195 crores come from the commercial vehicle segment and prominently from Europe. We would like to mention, in line what we had committed in the last quarter, kindly note that 47% of our new order book for the quarter one comes from the passenger car segment and another 15% comes from the automotive segment. We are maintaining healthy position in our commercial vehicle segment too by increasing our penetration in the European market. That's from my side. Thank you.
Thank you, Milesh. Now I hand over the line to the moderator for having the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Yes, sir, thank you for opportunity. Sir, I have few questions, starting with US tariff related impact in this quarter. How much impact, if someone has to gauge about that, we have to absorb the tariff before it gets negotiated or settled down within the us and OEM customer? And what was the effective tariff rate we applied during the quarter on whatever we exported to North America or US?
Mitul, for quarter one, our tariff rate for light vehicles, light LV and passenger vehicles was 25% flat as in auto tariff, and for commercial vehicle it was 10. And I think going forward also, as we see right now, the new tariff which has been announced is not going to be applicable on auto. Auto has been kept as separate field. So auto will continue to attract 25% in terms of passenger vehicles and 10% in commercial vehicle. As we understand today, unless there is a further change in terms of the final releases which come before 7th of August. And as of now, whatever shipments we have made till now, I think what has we see on the final prints will be charged at this rate unless there is a change in terms of the overall picture by the Trump administration. In terms of what has been the total outflow in terms of cash flow for the company, it has been close to around, for our US shipments, is going at around 6 crore rupees, out of which we have received customer confirmation to the tune of almost 50% of full pass on, and balance 50% we are still negotiating with the customers back and forth for the balance 3 crores to how and how much we will need to absorb, and how much will need to be paid by the customer. So I think it is still a fluid situation. I think in going forward, we will be having more clarity in next couple of months as to exact quantum of tariff in terms of outflow from the company or in terms of the overall basket of the company is done and how much is being paid by the customer. But as of now, whatever we have clarity, we have 50% which is being absorbed by the customer and 50% of the balance we are still negotiating. To just clarify your exact position to all our North American exports, almost 80% of our exports go into Mexico, which is not there in tariff, and we are just supplying our goods into the manufacturing locations of the customer in Mexico and Canada. All these are basically not in tariff. So only 20% of our portfolio to North America is getting into tariff, which is directly getting into US.
So just clarification, this 6 crore entire we have captured for the time, or only 3 crore we have taken in P&L, 3 crore we already got confirmation, so not taken?
No, we have not. We have basically not captured anything right now in our P&L. We have captured whatever customer confirmations we have received, we have captured in the P&L, and balance we have not yet captured.
So 3 crore for the time we have to absorb as a part of the...
No, but we still feel that it is receivable. I think we should be by end of, because right now customer does not also have any certainty in terms of what is going to be the exact tariff. So I think by end of August we should have a complete clarity on this.
Right. So my question is that in this P&L, we have taken the hit of 6 crore or 3 crore right now?
We have not taken any impact right now of the tariff in the P&L.
Okay. And the second question on the realization, sir, as currency is already going adverse or favorable in terms of the rupee depreciation, still our realization on export market as per the presentation has fallen meaningfully. So is it a commodity pass on or because of this tariff thing or any price?
No, it is basically, Mithul, I think it is, if you see the last quarter currency, if you are looking at it is in last 20 days currency has again come back. Otherwise currency year on year, there was a decline in terms of last quarter. And also there has been a steel price decline as far as index is concerned. So that steel price has impact. The fall in steel prices in the US market has brought the realization on the downward trend.
Overall, how much would be the impact of steel or how much steel price the impact we have taken in terms of realization, both for domestic export, roughly, per kg basis?
Lalit, can you explain?
Yeah. So, Mithul, the total what we have presented 31 crore is on account of realization only, and that's on account of basically there cannot be quantifiable against the steel and other area because indexes are other items. So overall realization it is 31.65 crore for the quarter.
Per kg you are talking, sir?
Yes, so per kg, if you look at Mithul, on domestic side, we have lost 8 rupees per kg, on the export side, 5 rupees per kg.
Okay, understood. So last question on this new order of 500 crore plus from the export side, we highlighted 300 crore from US OEM. So that is related to EV player, like that aluminum business, which we were expecting.
No, it is, yes, aluminum forging is still work in progress, and I think we should start seeing revenues from this quarter end or October onwards from that field. But this new order book is from the new OEM from North America market.
That is from PV or CV, sir?
PVs. I think Milesh in the opening statement has already clarified that this new order book, as we had said, our increased focus on passenger vehicle, this entire new order book of 300 crores plus is from the passenger vehicle.
And from ICE only, right? Right now?
From ICE.
Yes,
it is from the ICE segment.
Thanks, sir. Thanks a lot. I'll fall back in the queue.
Thank you. The next question is from the line of Bala Subramaniam from Arihant Capital Markets. Please go ahead.
Good evening, sir. Thank you so much for the opportunities. Sir, on that Mexico facilities, I think the machining operations has begun. So what kind of contributions we can expect from FY26 onwards? And is there any plan to expand into forging side?
I think in Mexico operations, we are only going to continue to add machining operations, the value add. Forging and castings are going to be shipped from India. And we have just started, and I think by the last quarter, we are supposed to increase our capacity, and we are going to see significant revenue in FY27 from our Mexico operations.
Okay, sir. So on the EV side, we are investing 3,000 tons plus for aluminum EV components. What is the addressable market, and how does this align with global OEM demand shifts?
I think we are very, very bullish about our aluminum forging, and this is our first entry into non-ferrous components. And this is just the start of our investment into non-ferrous. I think once we are able to successfully launch our non-ferrous activity, I think the demand side, there is a huge potential globally in terms of aluminum forging. So we think that next level of growth, I think in next couple of years, is going to come from aluminum forging, where we are looking at once we are successful and once we are able to move to higher utilization in this current capacity of 3,000 tons, we are going to just continue to replicate this capacity.
Okay, sir. So on that railway JV side, are we on track to commence the operation by Jan 2026? And what is the current status in the industry of wheel supply side?
No, I think for our wheel plant, we are well on track, and I think the plant is moving in a great shape. And I think we are on track to submit by last quarter of this financial year to submit samples for approvals for Indian Railways and look at getting significant revenue of 40,000 wheels in FY27 from this joint venture. And I think as everybody knows, this is a complete 80,000 plus wheels are guaranteed to be as an offtake plan. So we are not worried in terms of capacity utilization in this capacity.
Got it, sir. Thank you.
Thank you. The next question is from the line of Dhaval Shah from Greek Capital. Please go ahead.
Yeah, hello team. Thank you for the opportunity. So, couple of questions from my side. So first is on the P&L, what will be the impact of the the inventory correction which have been taken? So the EBITDA margin is 14.6%. So if you can help me understand, if I adjust for that inventory problem, what will be the EBITDA margin? And related to that, the warrant money which will be coming from the promoter side. So has any part of it come in the company, and any timeline if you can help with, and along with the current debt position of the company.
Well, I would like to address this question. First, on the promoter money, we are going to infuse this money very shortly, and we are waiting for the approval from the stock exchange, in principle approval, which we expect that after this, I think they were waiting for some formality to be complied with, and we are hopeful this will be done shortly, and we expect the money in next 2 weeks' time. Okay. Number two.
Okay.
There are no adjustment on account of inventory in the current quarter number. Okay, all the inventory adjustment has been done and accounted for till 31st March 2025. Okay.
Okay.
And I think what was the third part of the question?
Yeah. So I'll just take this. So this sharp drop in EBITDA margin year over year. So how should we read this margin? So is it because of a big operating deleverage because of only a 1% overall top line growth versus we were ready with all our capacities as of as of last year, and FY26 was the year of growth for us, and now given the lack of demand, volumes wouldn't have happened. So, how should we see this margin trajectory going forward, and also this 14.6% margin? Can you just help me understand the reason for such a drop?
I think, Dhaval, I think Lalit, if you go through the presentation and as Lalit has explained in his opening remark, almost 40 crore rupees of effect basically has been in terms of realization, in terms of mostly in terms of our export and domestic steel price drop, which has happened. And as you know that we had already shipped this material beforehand, and the consumption of this material has happened in this quarter, and the steel price decrease which had happened on 1st April had to be absorbed in the cost itself. And the customer, as our basically the trend continues, if there is a steel price drop in the quarter, the same has to be passed on to the customer from 1st April to 30th June. And similarly, from 1st July, there is a new pricing set in. So obviously, quarter on quarter, there is going to be a realization plus currency, both playing together, considering March ending. And in this quarter, the currency and raw material pricing both have affected the realization in our exports. And as well as there is a drop in realization in the domestic market also due to steel price decrease. So both taken together, we have almost had a hit of around 40 crore rupees, which has dented the margins. But in terms of overall performance of the company still expects that steel prices to stabilize and company to get back into the stable margin regime.
Okay, noted, sir. And this also regarding, I think, for discussion, we were discussing about the, the accounting for our shipments, once it reaches the customer's port. So is there also an impact because of that in this?
No, I think that was we have already taken in the month of March. And now we have the policy which was changed. I think that is in prevalence. And I think accordingly, you will see every quarter, the things will continue in the same fashion. I think whatever happened in the month of March now has taken into a regular precedent. Hello?
Yes, sir.
It has already, it has been taken as a regular precedent, and that is the way we are now new normal for us.
Yes. So, but in the base year, those revenues were recorded in the other. So that's why that next 2-3 quarters we should see that impact, right? Because in the base year,
not 2-3 quarters. I think it is. I think what you are seeing now is the worst behind us, and I think going forward you will see stably things going on an upward trajectory.
So, Dhaval, I would just like to further add what Nareshji said. There will be now no adjustment on the upward or downward side on account of that accounting norm or change in accounting norm, and whatever with the market demand and supply chain, accordingly the sales will be reported, and impact of that is now not there at all.
Got it, sir. And sir, what about the current gross debt, net debt position, and how do you see that over the next 2-3 quarters developing?
So the current net debt is about 1,800 crore, which was around March when we came out with the margin, but it remains at the same level. But we expect the debt will go down, which we also see on that call. So at least 300 to 400 crore debt reduction will be happening in this year. So by end of FY26, my debt level will somewhere around 14 to 1,500 crore.
Net debt
level. So because we are talking about the net debt on the console level, okay?
Yeah, net debt console level. Okay. Got it, sir. Thank you.
Thank you. The next question is from the line of Siddharth Pasi from SAS and B. Please go ahead.
Good evening, sir. Thank you for the opportunity. A few questions actually. So I'll ask a question, wait for your answer, and then ask the next. That's the best way to go forward. So, sir, firstly, we have obviously reported a sharp drop in profitability. So if we were to adjust for the one-time expenses that have happened, the losses on the currency, etc., and let's assume that would have not happened, what would our profit have been in this quarter? Because you mentioned there was a margin shift due to domestic and export mix. So what would our profit have been had the one-time machining costs and currency expenses not happened, assuming they will not happen in the future?
So at the console level, I think on a rough side, on an approximate side, we should have been higher by almost 300 to 350 basis points.
Okay. So about
Hello?
So 17 crores should have been, say, what would have been the ballpark number?
Can you repeat the question? It broke down in the middle.
So I'm saying the profitability right now is 17 crores. If we remove for the one-timers that have happened, including machine cost, currency cost, etc., what would have been our profit number if we take those costs as one-timers that they won't happen in the future?
So, you're talking about the PAT number?
Yes, PAT number.
So what you have to look at is, we have given you the impact on the price realization and the forex. And if that have been higher, so 45 crore have been added in the console profitability, and in fact, has to be reduced. So overall profit would have been on the console basis, would have been higher by almost 40 crore.
But almost at 40 crores. So we would have been somewhere around 57, 58 crores.
Correct.
Perfect. So next question, sir. How did we go wrong on the steel pricing? Don't we hedge our steel and currency? Because in the future also, steel prices may vary. So we can't have losses because of a change in steel prices.
I think steel prices we cannot hedge. I think we are buying steel in India and there is no hedge we can do in terms of steel pricing is concerned. Because when we export to US and all the contracts based out of US are based on steel pricing in US. So basically, both are two different geographies, and we cannot hedge in terms of steel pricings are concerned. So there is no formula, no place wherein we can hedge the currency. I mean, we can hedge the currency, but we cannot create an hedge on steel pricing.
Understood. So
basically, one more thing which you will need to understand, because it is when the customer consumes this part, that is the time the invoice is raised. So we need to have, with the current market situation, we cannot predict when the customer is going to ultimately consume the parts. And also second is that both geographies being different, if we may incur more losses if we start hedging and dates cross over.
Understood. So, sir, next question. When we are exporting to Mexico, this is basically to understand the tariff impact. Are we basically exporting to companies that are manufacturing in US, basically US companies, and are then exporting back to US? Or are we sending it to our own plant, which is then exporting to US?
No, we are sending to the companies who have manufacturing base out of Mexico, and they are assembling it into their full assembled part or vehicle and then exporting it to US under USMCA.
So, and the USMCA is obviously 94% of those goods are not being tariffed anyway. So we're not in any pressure that way.
Yes.
So the conversation regarding us suffering on the US tariffs is basically misplaced because Mexico auto imports are a part of the MCA, and we are exporting to American or other companies which are assembling in Mexico and sending to US. So there is no tariff impact per se on our case.
No, tariff per se on our Mexican shipments are not there, but per se out of our North American export, 20% directly go into US, wherein we are suffering this tariff impact. So that's the reason I said that 6 crore rupees to the earlier question. Last quarter, there has been an impact of 6 crore rupees on account of tariff.
Understood, sir. But considering a company of our size, that's a marginal impact versus what the street is estimating, or
I think street like for all our Canada shipments, we have FOB shipments. So as such also we are zero impacted, and the customer is picking up this and customer is paying for the tariff to Canada. And similarly for Mexico operations, all our material goes into Mexico and is shipped to the local locations of the customer in Mexico. We are not impacted by any tariffs for all our shipments to Mexico and Canada. Only shipments going into US are impacted. I don't know why what market is formulating at, but out of our total North America shipments in terms of our exports, 20% of our exports directly go into US.
Understood, sir. So just another question on then, is this the worst in terms of our margin performance and our PAT performance? And in the future, considering the market remains as it is, status quo, because for me, it's the worst of the market cycle right now. Are these the worst numbers RK Forging is going to give, and can we go back up to the 70-75 crore profitability by next quarter or the next to next?
No, I think in terms of profitability, in terms of EBITDA levels, I think with depreciation, if you see at the console level, we have a very high depreciation right now with all the new equipment and other things in place. At EBITDA margins levels, I think this is the worst which is there behind us, and I think you will see a gradual and a steady recovery in quarter on quarter, every quarter. And as already guided in our earlier calls also, company is doing what is required to go back to the old margin days, and I think it should not be too long before we get to that place.
Understood. Just a few more questions. Firstly, big compliments to Jalan sir and the family for standing by individual investors and the market for providing the inventory losses from their own pocket in terms of taking warrants at 2100. So just a question on that. Since you mentioned 2 weeks we're putting the money in, are we putting in the 25% or are we going to fully subscribe 100% to the warrants with the 200 crore amount?
No, I think to answer your question, as guided in our earlier call, we are putting in 25% on an immediate basis as soon as we receive stock exchange approval. But as committed, before the end of this financial year of FY26, the entire money is going to come into the company, and the entire 200 plus crores are going to be paid in and converted to shares from warrants.
Understood. And any, sir, other opportunities in terms of what the business is looking at, because I'm assuming with the tariff more Atmanirbhar Bharat opportunities open up, anything we're looking at on that front? And secondly, sir, since a lot of our money is coming from exports and the European market also, and a lot of our CV orders have come from the European market, any view on the market there and how is it performing? Do you expect an uptick there? Because in the last call you mentioned that the CV cycle is reaching replacement demand and that there will come a time when orders will be placed. Any views on that?
I think Europe is doing extremely well for us. If you see the last quarter also, Europe performance has been extremely good, and I think what we are seeing right now is extremely good traction from Europe, and I can very confidently say in FY27, our revenues from Europe are going to equally match North American operations. So I think we are not going to be impacted, or we are going to be only impacted for next couple of months for our North America sales. But Europe is one of the strongest market for us going forward and is going to make up more than what we are going to lose in terms of overall demand in the North America. We have not lost any business in North America. We continue to gain market share in North America, but overall market demand per se is down in North America. That is what is reflecting in our sales in terms of our North America operations. But if the sales come back, I think North America operations are also going to equally do well for us with the new order wins, both in non-auto and auto, which we have gained in last couple of months despite tariffs. We have won 300 plus crores from PV application, and rest North America orders are from non-auto segment. So keeping together, I think the flag for the overall exports, we continue to ride on new order wins, and we are extremely confident of doing well. To answer your second question, what more we are trying to do, we are increasing our wallet share considerably in the Indian Railways, and I think I'll be happy to say that we have just received approval few weeks back to supply the complete undercarriage in assembled form in Indian Railways for passenger coaches, and which will give us an incremental revenue of almost 50 to 75 crores in this financial year, and we are looking to do almost 300 plus crores of revenue in next financial year from only assembled undercarriage, for which we have already done and completed capex in previous year, and we were just waiting for final approvals from Indian Railways, and the approvals are already in place last few weeks back, and we are expected to supply the development orders which we have already received from Railways for about 60 crores in this financial year.
So why don't we, as a company, disclose these to the exchanges, our order wins, etc.? It would add more to the investor sentiment per se regarding, especially in tough times and tough markets.
I think we, as a policy decision, after what had happened in last year due to speculation, because of our order win announcement, we had lot of heartburns with our customers. So we have taken it as a policy matter to only do order announcements with our earning calls and not do midway any order announcements or anything related to that. So that is a policy decision we have made. We don't want to antagonize any of our customers in export market or the domestic market, and order wins without customer name also. There are a lot of speculations, and this speculation leads to a lot of heartburns at the customer end. So basically, we don't want to add on to all these problems for us.
So just one last question. This is more again regarding the markets in terms of, have you been in touch with other mutual funds since over the last couple of quarters? We've seen Aditya Birla and Aditya Birla Sun Life has completely sold out its holdings of RK Forgings, and a couple of other mutual funds have also cut positions. Are we in touch with any mutual funds to explain to them how the company is doing, what the company is all about, to get better people on the cap table?
We are always available to meet and receive any investors, irrelevant of the sizes they are concerned and irrelevant of the background. We are happy to take them through the performance of the company, take them through the plants of the company, and we are in always touch. Our IR people are always in touch with the investors. And I think at the right moment, with uncertainty, as the uncertainty fades away and as company performance improves, we are sure that investors will come back to the stock. It's a matter of time. I think we are patiently waiting, and I think that's what best we can do. We continue to work on what is there on the table for us and keep on performing, keep on navigating the tough times with new order wins, new geographies, and new business opportunities in these tough times. I think that's what is our job, and that's what we are doing continuously.
Right, sir. Sir, thank you so much. Just a couple of suggestions, if you don't mind. Since a lot of lay investors also go through the numbers, it would be great if on a press release, obviously you talk about the order wins of the undercarriage and the kind of profitability we expect from it and the revenues we expect in the future. Secondly, in terms of this quarter, optically the number of at PAT looks really bad and the EPS looks really bad. So it would be great in the press release if you explain that the one-times which have happened this time, including the steel impact and the machine depreciation impact and the currency impact, our PAT would have been north of 50 crores. So that would bring in a lot of confidence in terms of company performance.
I think this your suggestion, what you have given is correct. But if you see our presentation, we have already explained this 50 crores, why profit has been impacted. Line item wise, we have provided details in our presentation with the results. So if you go through the presentation, you will be able to see this 50 crores impact. We have mentioned line item wise what is the total domestic and everything. But your suggestion is well taken, and we will ensure more transparency going forward.
Absolutely. Thank you, sir. I'm an individual investor, recent new investor in the company. After seeing that you had an inventory issue, and then Mr. Jalan, how graciously he has decided to shield individual investors and retail investors by taking the hit upon himself and the family, shows that the company really means business, wants to do well. Although I just have 1 lakh shares, but it means a lot that you're giving us the time to small individual shareholders as well. Thank you so much, and all the best for the future.
Thank you very much.
Thank you. The next question is from the line of Aditya Agarwal from Old Bridge Mutual Fund. Please go ahead.
Good evening, sir, and thank you for the opportunity, and congratulations on good set of volume display. Sir, my question is on the firstly on the undercarriage order that you have got. Is this over and above the Vande Bharat order that you won maybe last year of 270 crores?
Yes, that is over and above. Vande Bharat order which we have received, that is from BHEL, and that is a private sector. Now what we have received approval also from Indian Railways and the order of 60 crores from Indian Railways directly to supply complete assembled undercarriage.
And sir, what's the status on that Vande Bharat order? Have we started the production, or are we still in progress of that?
No, we have already started proto manufacturing, and I think by October, we should submit the proto. Design and everything else has been approved by BHEL. Proto submission date is October, and we are well on track to submit it within October, or the proto submission is going to happen. And we have an obligation to supply, I think, Milish, what is the exact quantum by March we are going to supply?
So basically, for the first two train sets, that is the first two train sets of 16 coaches each, we have 32 bogies. So total 64 we need to complete by March.
Okay. That's
So the 64 is going to go to Vande Bharat, and the Indian Railway order is going to also directly go to Indian Railways, which is going to, we are trying to get that also completed. Our wish list is before March year end.
all right. So my second question is on the much newer segment casting. So if I look at the differential between Concall numbers and the standalone numbers, the amount comes out to be 78 crores. So is this number should all be proportionately to the casting segment?
Can you repeat your question, please? Hello, can you repeat your question?
So my question was on the castings part. So in standalone, we basically report the forgings piece of business, and with the new restructuring, we have done the castings have come into Concall business. So with this quarter, the difference between the standalone and consolidated is close to 78 crores. So should we proportionate the 78 crores to the castings fully to the casting segment?
Yeah, mainly to the casting. That's the majority from the casting only, and little bit from your Mexico, US, and all.
Sorry to interrupt, sir. Your voice is not clear properly.
Hello, are you getting my voice now?
Yes, sir. Now it's better.
Hello.
Yes, sir. Now it's better.
Yes, sir,
Go ahead.
Yeah. So I was just verifying. It's largely to the casting business, huh?
Okay. So, given that, if I compare this number to last year this number would have been around 73 crores. And given that we have given a very healthy show in the domestic volumes in forgings, so what is the kind of ramp up we are looking in the casting segments? Like, what is the current utilization of the capacity, and what is the volumes that has picked up in the casting part?
Casting, to answer your question, we have the capacity which we had acquired is almost running at 90% plus utilization. I think new capacity which we have set up is going to go into production or trial runs, I think, in next 2 weeks' time. So we are hoping for a higher utilization casting in this quarter, and in next quarter to go almost to a monthly run rate of 6,000 tons. So I think we are looking at almost in the next half to double our top line from the casting.
Okay, so castings is currently running at 90% utilization, right?
Yes.
Okay.
And new facility of the casting, the addition of the casting facility which we have done for a close to 40,000 metric ton is going to go into trial runs in next 2 weeks' time. So that capacity is going to add up to this capacity. I think almost 2 times the capacity we have new put up. So this is going to create revenue in the next half of the year for us.
And you are looking at 6,000 tons of monthly volume offtake, right?
Yes.
Okay. So what will be the full, I guess the full capacity after the new addition will be close to 63,000 or 64,000 tons, right?
Almost around, we are looking at 70,000 tons per annum.
So technically we are looking at 100% kind of utilization from day one.
No, we are looking at 90%. We have a confirmed order book from castings, and I think we are just waiting for the entire capacity. As soon as it comes, we are looking at in the next half to go to almost 85 to 90% utilization from castings.
So if I just may ask, sir, what would be the per ton realization in the castings business you have?
Lalit, can you per ton, what is the realization in castings?
So it varies like 120 rupees kg around. When we are fully machine the product.
Sorry, sir, your voice is cracking. Really sorry.
Yeah. So it's a range between 120 to 150 rupees per kg.
Okay, and this all will be machined, right?
Yes, 99% of the castings we are supplying is in machine condition.
Okay. Okay. Thank you. Thank you for that. And just one bookkeeping question. This quarter, our other expenses came in around, I'm saying for the standalone business per se, 197 crores other expenses, which was down last quarter from last quarter 5% on a YOY basis as well as 4%. So what has driven this, driven the downward trajectory of these expenses?
I think you will continuously see downward trend in terms of our other expenses. I think with the kind of cost cutting and other things we are able to do, I think you in terms of processing charges and other things, the way we are right now working on it, you will continuously see a downward trend in other expenses for near future, and that will be the new norms going forward in RKFL.
Okay. Okay, sir. Okay. Thank you. Thank you.
Thank you. The next question is from the line of Sunny from MK Ventures. Please go ahead.
Yeah. Hi. Thanks for taking my question. Basically, I think this has been asked before, but I would still like to understand this rate impact and mix impact on the inventory. Basically, while we understand that there is some rate difference in the export and some inventory which is lying in the warehouse, but there is a 24 crore impact on the domestic tonnage due to realization. But wouldn't that mean that although the realization has dropped, our raw material cost also would have, like steel prices also would have dropped, and that impact should have gotten neutralized. So, like, how is this impact of 24 crores coming from the domestic volumes? And isn't this like a routine phenomenon in the business, or is this like something which has come up one time?
No, I think, Sunny, to answer your question, in terms of domestic realization, the market did not go up as we had planned the inventory. So basically you can see that there is an inventory hit. And inventory, you are right when you say that whatever steel price decrease happens is also happens with the steel mill suppliers. But steel mill supplier does not give us for the reduction based on whatever inventories we have in the system or inventories we carry through. So all that hit has to come into the P&L, and we have to absorb as suppliers to the OEMs. Going forward, yes, we have already started getting new pricing inventories, which you will see in coming quarters. This will not get reflected in the balance sheet in the P&L. In terms of our exports, the realization, the shipments which we had already done with the previous raw material, and US raw material has dropped more than the domestic raw material. And that's the reason we have a higher hit in terms of the overall shipments to the export side.
So export is well understood.
And that is coupled by the currency also.
Got. No, export I think is well understood, but domestic was something. But basically, what you are saying is that you had excess raw material in the opening inventory, which was at a higher cost, and basically your selling price is determined on the current running price of steel.
Yes.
And as you basically ran down the old raw material inventory, your cost was to that extent higher, but realization was based on the current pricing, which kind of impacted the margin in this quarter. Now, basically your current closing raw material inventory and the realization that you are getting from the customer is in line with each other.
Yes.
So that impact will effectively not get carried forward in the future quarters.
Yes, you are right.
Got it. And second, on the mix impact, while I understand a higher domestic mix should impact your percentage margins because your export margins in terms of percentage is better, but like how does the mix impact in terms of the absolute EBITDA? Like how is that?
I think in terms of our overall exports, our realizations are at least 150 basis points or 200 basis points higher in terms of profitability from the domestic supplies, which has been impacted basically because of mix change domestic going higher and exports going down.
Got it. Okay. And basically this 5 crore forex loss impact on import of capex of say 5 crore standalone is above EBITDA impact. So basically net about 45 crores of impact would be above EBITDA. And
Yes,
this
and,
6.66 crores is coming as part of JV.
It is JV
loss.
and it is directly get knocked off in the PBT.
Got it. And would it, like, in terms of the normalized margins, so like if we adjust the 300 bips, approximate 350 bips of margin impact from in the current quarter, so that number comes to about 17 to 17.5%, which is kind of still lower than your erstwhile margin of 21-22%. So is there a pathway to that 21-22%?
Sunny, I have answered this question previously also. With the storm we have weathered in previous quarter, and I think you will see a quarter-on-quarter continuous efforts with margins getting improved, and we are very hopeful by the last quarter or first quarter of financial year FY27, we should be back to our old days of margins on a standalone basis. And while casting business gets consolidated, casting business, while we will be able to crop a very high level of revenue and utilization with the kind of order wins we have and with the kind of traction we have from the customer, but that will never be a 20-22% margin business for us. Casting will always remain to be a 16-17% margin. So on a blended level, we are looking at almost margins on a standalone. RKFL should get back in next 3 to 4 quarters back to their old margins business.
Got it. And just one last question. Basically, your export pricing is on a quarterly basis, but how often your domestic pricing is with how does it get repriced in the domestic market?
Domestic market, it depends on the OEM directly negotiating with the raw material supplier. So we have no role to play in that, nor there is any index based on that. It is basically the raw material supplier negotiates directly with the OEM, and as we receive information from the OEM on the quarter basis, it immediately takes an effect. But everything, whatever happens on starting of the quarter and is applicable for the entire quarter. There may be price rollover also, there may be a price change also.
Got it. So this quarter, unfortunately, you got caught in the wrong cycle with high inventory, and basically on, say, the starting date, the OEMs negotiated a lower price with the
steel mills.
Supplier.
Yes.
Got it. Thank you for the detail.
Thank you. The next question is from the line of Devang Shah from Asset C Mehta Investment. Please go ahead.
Yeah, hi, good evening, sir. Just to ask you, the way earlier we guided very optimism as far as our revenue top line and bottom line. We can understand last quarter there was some kind of inventory correction, and in the initial remark of your commentary today you have mentioned some kind of slowdown and certain global related challenges is impacting the company's performance. But certain also opportunities also you have shared in this particular call also. So just I would like to know that our aspiration to have some kind of 25% kind of top line growth, and as you have mentioned, gradually we will come back to our normalcy of a margin of somewhere 22%. So it will not be a too longer also, you have mentioned to earlier participants. So that's what the only question, that in this particular financial year, can we able to have such kind of achievement by the end of FY26? I'm not talking about the quarterly performance. I can understand it may have some kind of challenges, but my question is that by the end of FY26, we can have some kind of possibility of achievement a top line somewhere close to 25%, and also come out to some kind of 22% or some kind of plus minus margin relatively close to that.
To answer your question, I think in opening remarks of Lalit, whatever he has said, is based on tariff and other things, what are applicable and what is concerning the market and what is our view related to the tariffs and other things. It does not mean that we are not working or not burning midnight oil to ensure that our performance does not decline vis-a-vis the industry. And as in the past, we have always outperformed the growth in terms of the overall industry, and we will continue to do so. And as we have guided in our previous call, we have never guided for a 25% growth on a yearly basis, but we have guided for a volume growth of 15 to 20%, and with the kind of capacities and other things are coming in place in next 2 months. And I think as guided in our earlier call, we had clearly said that almost 80 or 90% of our entire project to increase capacity both in castings and forgings are going to be in place by end of September. So once all these capacities are in place, we are looking to have a very healthy second half of the year, and we still believe that this phenomena of market slowdown is not a long-lived situation. And I think for the full year basis, we will be on a growth trajectory on terms of overall volumes, in terms of our top line, and in terms of bottom line on a standalone basis, we are very confident that every quarter on quarter there will be significant increase, and we will strive to get to the old days of profitability of the company on a standalone basis. The new capacity which is getting added in casting will never be a 22-23% business for us. And as guided earlier also, while we will get significant volume and significant top line from our casting business, which is 100% subsidiary of RKFL, we will outperform the industry both in terms of volume growth and in terms of profitability in the castings also.
And my second question, sir, as you already mentioned that due to tariff-related challenges, that's what we are now witnessing as far as, general geopolitical situation is concerned. Do you, as we come out any kind of, solution through terms of, trade agreements kind of thing, do you feel the situation and the outcome may change in a coming quarter as well? That's what something possibility.
No, I think right now, like I said in to earlier question, we have learned to live with 25% auto tariff, which is in place, and I think we are in process with discussing with all our customers and all our stakeholders for all our US shipment. Again, I would like to stress on that our total North America exposure, only 20% of our shipments go directly into US, which is, as of now, last quarter has been impacted by almost a tariff of 25%, which is 6 crore rupees. And on a full year basis also, if you can see the 6 crore, if I put it on a full scale basis also, it's going to be 20-25 crore rupees on the full balance sheet. So basically, we are looking at this kind of tariff numbers, and we are negotiating with our customers to for a 100% pass on. We have almost received 50% confirmation from our customer for 100% pass on, and we are not speculating in terms of if there is going to be an FTA, what changes it can happen and how much time it's going to take. I think it is very difficult for us to do those guesswork, and I think we are not looking at or not speculating based on what FTA brings and what final. If anything happens on the downward trajectory, it is good for us, but we are getting prepared ourselves with the current numbers, and we are working with our customers on the current numbers. We are just waiting for demand outlook to improve, and as you may be aware or you may be seeing the details, overall auto industry in US is suffering very badly for this tariff related issue, and I think we will just need to wait on the sidelines and watch how the demand side improves.
Understood, sir. Thank you so much, and wishing you all the best.
Thank you. The next question is from the line of Viral Shah from Enam Holding. Please go ahead.
Yeah, hello. Thank you for the opportunity. Sir, some of my questions have been answered. Just one clarificatory question. You said you expect to reach 21 to 22% EBITDA margins by Q4 of 26 or Q1 of 27. Is that correct?
Yes, on a standalone basis.
on a standalone basis. And then how are you looking at these numbers in the next year? Do you think there is scope for further improvement, or do you think the stabilized margin should remain at 21 to 22%?
I think as a company, we are always working to improve margins, and I think with the capacity utilization improving, with the kind of new capacities getting augmented by September, our aspiration is to be on the upward trajectory of the margins. I think with our acquisition stabilizing, and I think the crankshaft machining plant, which is merged with RKFL, I am happy to state that from this quarter onwards, we are going to start seeing profitability coming in from there, because the utilization level has improved, and we are looking at on a full year basis to get a significantly good top line from those facilities. So these are all going to be an improvement side in terms of the overall margins. But to be very cautious, we are taking a longer lead time in terms of expectation building in terms of our investors. We don't want to overcommit, and that's the reason we are building in 5 quarters from here, when on a safer side, to be hitting those margins on a standalone basis.
Sure. So my next question is on your expected outflow towards capex and investments in the current year, and accordingly, how are you also looking at the net debt progressively coming down, because you also had an elevated working capital last year. So how are you looking at both?
I think Lalit has answered to this question. We are looking at almost 300 to 400 crores decline in our net debt levels on a console basis by end of FY26. And basically, right now the current net debt is close to 1800 crores, which is same as what was the closing of March 25 balance sheet. And we are looking at this year to end somewhere in anything between 1400 to 1500 crores as net debt of the company at a console level.
And sir, what is the assumption of capex and investments in this, sir?
I think in terms of, Lalit, can you give the exact numbers of investments and capex?
So coming to the investment part, we have already invested 370 crore in the GV. So 230 more crore will be invested, 150 crore further will be invested in GV in next 1 year's time. And coming to the capex part, there will be a capex of 350 crore in this current year.
I'm sorry to interrupt, sir. Your voice is not clear properly. Slight breaking.
Yeah, I think it's better now.
Yes, sir.
So coming back, so the capex for the current year is 300 to 350 crore. And I said the investment, we have already invested around 370 crore in the JV. 230 crore both partners together will further infuse. So about 115 crore will be our share in the investment.
Okay. So 415 to 450 crores is the kind of outflow that you will have this year from capex plus investments.
Yes.
Okay. Just lastly, sir, a clarificatory, sir, what should be your tax rate in the standalone business this year?
So, see, tax rate is 25% only, and but we have not provided for any tax on account of merger with the ACIL, and only there is a correction in deferred tax asset which we created in last quarter.
Okay. Got it. Okay. Thank you so much.
Thank you. The next question is from the line of Hardik from SP Dara and Associate. Please go ahead.
Hello, sir. Very good evening. Thank you for the opportunity. I just had 2 questions. So first, sir, what is the long-term strategy going ahead for RKFL? So what I mean to ask is, are there any new products under development, or we are looking to consolidate the casting and forging traditional business that has been going on?
No, I think we are working aggressively in terms of new product developments. I think, like I answered the real question, we have just received approval for complete assembled undercarriage for passenger vehicles, and we look at extremely solid set of numbers coming in next couple of years, and with the passenger vehicle segment growing in Indian Railways significantly, I think there is a lot of work to be done and lot of revenues to be created in coming years. And I think this is a significant milestone in terms of the overall development of these assemblies with mix of forging, fabrication and casting together. So I think that's one of the game changers which we have been able to get an approval in a very short span of time. And a development order, I think my marketing people have done a extremely good job by getting an order which worth about 60 crores, which we are going to fulfill by March 26, and look at a bigger chunk of business in next financial year. To be more precise, railway buys close to around 1,000 to 1,500 crores worth of fully assembled undercarriage per year for passenger coaches. So I think for next year onwards, this entire post this completion of development order will be eligible to supply for the complete kitty, and we have set up a very significant capacity for this. So we are looking at to do a significant number going forward in next years onwards in this undercarriage itself.
Got it. And sir, my second question was, since you said the casting business is a 16 to 17% EBITDA business, so on a blended basis, what margins should we expect on the consolidated front for the next 2-3 years?
Lalit?
So, if you look at the casting plus forging EBITDA margin blended basis, so casting business will be somewhere around, if you look at the next year, will be 20 to 25% of our business altogether on the full year basis. And if there is a 500 to 600 basis point gap, so there will be 100 to 150 basis point overall reduction from the standalone to console number. So suppose we reach to a 22% of EBITDA, so console level it will be somewhere between 20 to 21.
Got it, sir. Thank you so much. Thanks a lot.
Thank you. The next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Yes, sir. Thanks for follow-up opportunity. So first question on this railway JV. As per presentation, this 2,000 crore capex is on, and nearly 350-360 crore equity infusion is already happened. So what would be the debt component, or right now what is the current debt on JV, or how much total debt plus equity is invested so far?
So the construct of JV is 70-30. 70 is debt, 30 is equity. So 30% of equity constitutes the 370 crore what we institute, and proportionate amount of about 900 crore has been debt. So total is about 1270 crore is invested so far in the JV.
Answer to your question, Mitul, to answer your question, the 2,000 crores project investment is in two phases. So first phase will not require the entire 2,000 crores. We are looking at close to around 1,600 crores to be spent in this first phase, where we will augment the capacity of machined finish 100,000 plus wheels, which will suffice my requirement for Indian Railways up to FY28. So second phase of investment of 400 crores, which is going to happen once we have a utilization level of 100,000 plus wheels sent to Indian Railways. Then only we will invest the second phase to augment full capacity of 200,000 plus wheels.
Okay, so incremental only nearly now 120 crore equity infusion is pending for first phase, and another 300 crore could be the debt, right?
Yes.
So that is also like a nearly 1,000 crore debt on JV, apart from our existing this 1,800.
But I think the JV does not carry risk in terms of RKFL console is concerned, and neither this balance sheet is getting consoled in RKFL right now. So obviously this debt is not, and debt is entirely on plant and machinery and land bank of the JV which is concerned.
Yes, sir. And second, sir, just a clarification on this impact we have highlighted in our PPT mix as well as this raw material thing. Nearly about 40 crore seems to be because of this raw material thing, as you explained earlier, in carry forward inventory at a higher cost material purchased in previous quarters. But this 11 crore forex impact is again on the import of the capex, so that would be part of the balance sheet, or we are factoring that capex related impact also in P&L?
So I think RKFL on a standalone basis is about 5 crore rupees, that is above EBITDA, And the balance on the JV which is there, that is part of PBT. So I think on the console basis, this entire quantum of 15 crores has been, or 16 crores has gone into the balance sheet.
So, because further to clarify, on the standalone basis, everything is part of EBITDA. So 45 crore EBITDA, and you can on the console basis again 6.6 crore of JV also routed through PL only as a separate line item. So everything has been routed through PL. Nothing has been routed through this balance sheet.
Okay, sir. Understood. And as we highlighted, about 300-350 basis impact is at a EBITDA level, right?
Yeah, 300.
Earlier we highlighted that impact of 300-350 basis because of this raw material, and we have passed on the benefit immediately. So that implies nearly 35 crore kind of a 30 to 35 crore on absolute basis.
Just
so
I will Mitul, if 40 crore plus 5 crore, 45 crore, you have to utilize that by tax of 25%, so it comes to around 34 crore. That is 300, which is 0.1.
So post-tax impact we are considering in profitability. Lastly, sir, if we assume raw material prices, steel prices doesn't change Q on Q and Q2, so can we expect direct this benefit or impact going away and 300 basis type of a jump in profitability Q2 itself? Or we see that every quarter we may realize just 50-60 basis and gradually will go to this 200-300 basis improvement in overall by Q4?
Lalit, can you answer to the Mitul's question?
Mitul?
Yes.
So what I understood from your question, what you are asking, next quarter, how the margin will move? It will be a
I'll repeat the question. My point is that if the raw material steel prices remains flat Q on Q in this quarter, Q2 itself, so can we realize this entire 300-350 basis benefit in Q2 itself, for this journey to improvement of 300 basis will be gradual with a 50-100 basis every quarter improvement till Q4 or next
so
year?
it's not that simple. It's not that simple because it depends a lot of things. So they see the domestic export mix plays a big role here. You see realization and the mix. So you have seen the mix has changed. If mix move positive, rather from 64-30 is moved for 60-40, it will have more positive impact. If mix remains like this, there will be no improvement on that count. And certainly price realization and product mix also has to play a role. But certainly the inventory correction part will be not there, so there will be improvement. But it's very difficult to quantify in terms of basis.
Okay. And sir, last one thing, again, as we highlighted, our ambition to reach to 21-22% EBITDA margin by fiscal end or maybe next year first quarter. So if we look at the historical peak margin of about 22%, and if we consider the inventory related error in past 1 or 2 years, then adjusted realistic margin would be somewhere closer to 20% as we calculated 200 basis impact of the inventory. So do you mean that we would surpass that historical peak also in next 3-4 quarters and will go to 21-22%?
Mitul, as to answer this question previously, that previous participant also asked in terms of our other expenses. If you see, we are working significantly in terms of our cost structure, and there has been a significant reduction Q on Q and year on year in terms of our other expenses. And you will continuously see improvement in terms of our other expenses. I think it is a journey which we have started, and I think in next 4 to 5 quarters from here, what inventory related was one-off time issue on a standalone basis with the kind of capacities which we are building in next 2 months. Most of the capacities are going to be in place. With this, we are very confident with the kind of order wins we have had in exports and the domestic. We will be able to surpass our previous margins in next couple of quarters.
Yeah, really great, sir. Great, and all the best, sir. Thanks.
Thank you. Ladies and gentlemen, as that was the last question for the day, I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you. I would like to thank all the participants for taking our time to join our earnings call. I hope we have been able to answer and address all your queries. For any further information, can you get in touch with us or with CDR India? On behalf of Ramkrishna Forgings Limited, we wish you all a very wonderful week ahead. We look forward to interacting with you again in the next quarter. Thank you very much for taking up our time again. Thank you.
Thank you. On behalf of ICICI Securities Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share, and subscribe for latest upcoming videos.